Hey there, Dale.
Hey, how you doing?
I am doing pleasant. Good morning and happy Tuesday to you.
Yeah, it is a happy Tuesday. Same.
Well, let's jump in. Short one today, I think. Mortgage-backed securities, they are kind of hovering right now. There are big swings in the market. We are coming hot off the heels. All of the days of small incremental changes are falling off our chart, Dale, and it's just wild swings everywhere. But we are settling in between all of these moving day averages. These colorful lines aren't there just for show. They are indicators of where the general trend of interest rates and mortgage-backed securities are going. And we're smack dab right in the middle. We are settling on a very average spot. Green and up is good, red and down is bad. What does this translate to on regular interest rates?
Yeah. So you've got, 6.84 on a 30-year fix, 5.97. Again, this is Fannie Mae, 20% down. All credit scores, all points. So, they're starting to level off a little bit. Obviously, If you're putting less down, you're going to have a higher rate. Doing a different type of program, VA, FHA, those are not part of this. They are completely separate.
And I want to harp on one thing a little bit, Dale, is that this is for 20% down and discount points.
Right.
That's really critical because, if you're a first-time home buyer, 3% down conventional, I can almost guarantee you're going to be in the sevens.
Yeah, easily.
Yeah. So keep that in mind. Interest rates are high, but let's talk about the good and the bad because we're seeing that we're stuck in the middle with mortgage-backed securities. And what is it going to take? Well, year-over-year inflation's at 2.4%. Technically, a 0.1% rise over last month, which is not the greatest, but still, we are right in the money zone for the Federal Reserve to drop rates. But rates are still high. Dale, why?
The biggest reason, and let's wind up back a little bit, inflation is 0.1% higher. Not 1% higher, 0.1% higher. So if you look at it in monetary terms, you pay $1,000 for something, now you're going to pay $1,001. So it's not this huge leap, right? It's all in point percentages, but the bottom line is uncertainty. Yes. Everywhere you look, whether globally, state, internally, anywhere, uncertainty. What in the world is going on? And that is the challenge.
Right. And a year ago, one of the challenges was inventory, Dale. We were constantly bugging about that there's buyers, but there are no homes. And that's what drove prices up, even though interest rates were still high. And now buyers are on hold. There is truth to that. Buyers are on hold and inventory is high. Well, one of the contributing factors is rents have been down for 22 months straight. Now, very small changes every single month, but if rents are going down, why would I buy when rates are so high and housing prices are high? So honestly, if the Federal Reserve could simply do what they promised previously, lower rates, not only would buyers come out of the woodwork and start buying market, but inventory would balance out nicely and we could start to see a lot more action. Let's go into Israel versus Iran. War anywhere is always bad for interest rates. It develops more uncertainty, as you said. Labor market has slowed down quite a bit. This is an indicator of the jobs falling off and a recession coming in. And a recession is always a big indicator that the Federal Reserve is going to lower interest rates. Hence another reason why we're all throwing our hands in the air saying, why hasn't it happened? Tariff fears. That's always a big one. Dale, your favorite word, uncertainty. But what's going on with the U.S. and China?
Well, tariffs tomorrow are going to be 200%. But then the day after tomorrow, they're only going to be 50%. It's just insanity. Regarding U.S.-China, word is there's a deal in place. We don't know what the deal is. It has yet to be seen, but supposedly they're coming to some sort of agreement. And if that gets penciled in and gets some signatures, hoping that will help us, at least
Yep.
the uncertainty part.
Yeah, definitely. That's pretty much what we're looking for, because we have slow global growth. And I'm not going to comment too much on this, Dale, but global growth is at the same levels as 2008. I'll leave it at that.
Yeah.
So without further ado, that's our market update. Hope you have a good one. Dale, thank you so much.
Have a good day.
Okay, bye.
Bye.